what has changed for you, and what does that mean for your asset allocations and your recommendations there?
So for the last couple of months, we've been worried that the Fed was going to make a mistake by over tightening in the face of falling inflation. We're now more concerned about persistency of inflation and the Fed's hikes being justified by a higher rate of inflation. But what's important is not the prediction of where inflation is going to go, but what does it mean for stocks, bonds in your portfolio? So we can talk about how we think portfolios should be positioned for the risk of continuing higher inflation.
We've had very ominous calls coming from the likes of Jeremy Grantham, for example, talking about this inflation concern, really not giving any leeway for the Fed to do anything if the economy succumbs under the weight of all of the issues around the world. What are you seeing in terms of the economic prospects, and what could that mean for markets?
Well, the economy is still in very good shape. If you look at the pent-up demand, there is $2 trillion of excess savings in the U.S. alone from the pandemic. Corporate inventories are extremely low. Capital spending's been low. The primary risk short-term is the Omicron variant and what it's doing to activity. It's clearly hurt activity in December and January in the States. And you earlier talked about the Chinese supply chain issue, which I think is real. But there is a lot of pent-up demand globally, which we think makes the global economy probably mid-cycle here. So we still have several years, I think, of clear growth ahead of us that will underpin risk-taking over that time period.
And is that why you, perhaps not for all of those several years, but at least for the time being, you're still underweight fixed income and are willing to take on that greater risk?
Sure. So you have to fund your overweights with something, and we've chosen to fund it out of investment-grade bonds and inflation-protected securities. We're not overly negative on interest rates, but if the risk case of higher inflation does come through, you will see underperformance out of the bond market. And just looking at the template of 2021 and what performed well during a period where inflation was way above anyone's expectation, what really worked? The equity markets in the developed world performed well. Corporate pricing power held up. You had good performance out of real assets like natural resources and global real estate. So those are some of your most natural hedges against the risk of higher inflation. And in that environment, investment grade bonds struggled somewhat. TIPS had a nice performance. And the last thing I'd highlight is high yield bonds, which actually have little exposure to interest rate moves. Higher interest rates tend to occur during a better economic environment, and that helps credit in the high yield space. So those are the three primary areas that we'd look at: global equities in the developed world, natural resources and real estate and real assets, and then the high yield over investment grade bonds.
And you're not in the camp that sees finally the revival of EMs this year?
No, we're not there yet, but we're also not negative on emerging markets. I think it's important philosophically to accept that you don't always have to make a big bet, either bullish or bearish, against an individual asset class. We just don't see a really clear case after the significant underperformance of EM, why it's going to continue in 2022. Having said that, it seems like every week there's another announcement coming out of China about a new platform within the Common Prosperity Program that raises investor concerns. So we just don't really see a strong either bullish or bearish case for EM so far in 2022.